Welcome back to the channel, everyone. Today we're going to be talking about how I'm preparing for a possible stock market crash or correction. We'll be discussing how likely it is the stock market will crash, and we'll also talk about which areas of the market are most at risk, what I will be doing to be ready, and how you can capitalize on a crash or correction in the market. I'd just like to be clear, I'm not saying there will definitely be a crash. This is just a representation of the facts and a discussion around how you can develop a strategy that will enable you to thrive in a stock market crash. We've now had various famed investing professionals warn of a crash or correction in the next few months, but I'm going to keep this short and sweet if I can. It isn't really that complicated, and all you need to do, in my opinion, is follow some basic investing framework to be ready. So how likely is a market crash or correction? In my opinion, it's not a case of if, but when. I can't tell you when it will happen, but if we look throughout history, every economy, every stock market crashes at some point. It usually happens every decade or around a 7 to 12 year time period. So it's inevitable that it will happen at some point. The short answer is we will never know for sure. Not many people have ever been successful in guessing when a stock market crash will happen, but throughout history there have been a few pricing indicators that would have signaled the markets are ripe for a crash or correction. And there are two that I would like to look at now. So first we have the Shiller PE, and this takes into account the price of an index, in this case the S&P 500, divided by the average 10-year of earnings going back and adjusted for inflation. This has ordinarily been a good indicator, as you can probably see, from the highest points being the dot-com bubble. We've got the financial crisis here too, and then if we go back a little bit further, we start to see some of the other more volatile times in the market where a crash did happen. This has now reached near to an all-time high. We're not at the all-time high yet, but it's near enough near the dot-com level, around the times of the dot-com bubble. Some people think it's justified, but if we're going by numbers, then we are 200 percentage points away from the historical average, which has only happened once before. Another good indicator is the S&P 500 earnings yield, which takes current trailing 12 months earnings per share divided by the price of the index, the inverse of the PE essentially, and we are near all-time lows. Only the financial crisis and crash of 08-09 had a lower earnings yield than we are today. The historical average is 7.32%, and we're currently at 2.5%, or 300 percentage points away from the average. Although if we look at just the last 30 years as an example, it looks like we'd be nearer to around 5 or 5.5%, which is only 200 percentage points away. Still quite far, but not as far as the 300 percentage points we have if we're looking at a 100-year period. So I recently ran a poll on my community tab to get some of your opinions on what the answer is. And the majority of you feel that it's because the future growth rates are higher than we would have witnessed before. So if we do some quick analysis, just to check if that makes sense in the numbers. So since 2002, for almost 2 decades, the average EPS growth for the S&P has been 7.6% as of this piece of research. Now also factor in that these are 2 of the most productive decades and most fast-growing decades that this economy has ever seen. And if we're priced at a 200 percentage difference either on the yield or PE ratio, whichever way you look at it, then that means that we need to see an economy or market, or in this case the entire S&P 500, really we're segmenting down to, that needs to grow at double the rate of the historical EPS for the next decade to make this argument. Now that's not astronomical, but I see a lot of declining businesses in the S&P 500 as well as the economy in general, although I do see some very good ones as well that will likely have very high growth going into the future. And this is where we start to see segments of the market that are more vulnerable than others. If we go by this Goldman Sachs estimate here, they see EPS growing at around 31% in 2021, but then falling down to 10% in 2022. And this does get us on track for 15% earnings per share growth for the next, say, 2 years. But if growth has already stalled to 10% by 2022, it's likely the average will come down. And remember, we need 15% compounded for the entire decade for the math to work on this one. So it's up to you really to decide whether you think that that's possible. And it's almost the certainty that the economy itself, the entire economy, will not grow at that rate in terms of GDP. But maybe the S&P companies will separate themselves from that in a big way. And in terms of catalysts for a stock market crash or correction, I think we all know the core catalyst that could cause a market correction, and it's interest rates. Along with stimulus being pumped into the economy, interest rates were probably the proximate cause of equities rebounding from the 2020 lows in such quick fashion. With interest rates as low as 1.3% on the 10-year Treasury bond, it's no wonder people turn to all-in with stocks. And with the Fed expected to raise rates somewhat to protect against uncontrollable inflation, especially when there's still 10% unemployment in the economy, you don't want inflation when that's happening, it should be expected that stocks will adjust their pricing to reflect the opportunity cost should the Fed start to raise rates even more. It's also the case that most investors utilize the risk-free rate to calculate equity risk premiums, which, when they are so low, makes stocks seem relatively cheap, even at today's levels. Okay, the next thing we need to talk about is the vulnerable areas of the market. And there's about 4 areas I want to cover that actually link in with each other, but the deeper I can define them, the more beneficial it will be. So first of all, young loss-making businesses. These stocks are always the ones that sell off the most en masse when there is a market crash or correction. And a lot of the time it's because they haven't really got proven products, or a lot of them don't even have a product at all, meaning that it's hard to predict how well they will fare in the current environment or in times of distress. Also, they're not making any profit, so they're less defensive in that sense. And a lot of them have to take on debt, so they leave themselves in a position that's vulnerable to bankruptcy and essentially at risk of your investment going to zero. The next area is stagnant growth areas or stagnant growth businesses. It can be an industry as well. Inflation will kill the real returns of these companies. Now, a lot of these companies, you can spot it a mile off. They've had stagnant revenues or stagnant earnings, a lot of them declining as well, or they're in an industry where they're being disrupted by some new technology or better way of doing things or delivering a product to market. Stay away from these businesses. A lot of these businesses look cheap on the face of it. I guess you could say they're a deep value play, but they're not, in the sense that there's not much value left in the business. They could be branded as those cigar butt businesses like a Buffett or Ben Graham would brand them, but there's usually a very good reason why a stock looks that undervalued. The third one is blank check companies or SPACs. And the problem with a lot of these blank check companies, though, links in with the first point, in that they're young, loss-making businesses. A lot of them don't have a product, and essentially a lot of them are just cash. So cash is trash in my eyes. I wouldn't sit in these for that reason, unless you have a high conviction about the business in which the SPAC is merging with, and you have an idea of how likely that merger is to go through. And the fourth one, in my eyes, is quite vague, but I wanted to put it in there to make a point. So speculative businesses. Of course, you don't want to be in speculative stocks in a time where the market is correcting or crashing. Similarly to points 1 and 3, these are going to be the businesses that if the market drops 20%, they drop 50%. That's usually how it works. However, we need to define what speculative is, because at one point Amazon, Apple, Tesla, even Google to a degree, but let's pick on Amazon as a good example, was viewed as a speculative bet for investors at the early stages. And this is only going back, less than 20 years. A lot of people who invested in Amazon in the early 2000s were laughed at for doing so. And there's a degree in which you can see why they were calling it a speculative business. It was hard to see Jeff Bezos' vision for Amazon unless you were working inside or knew exactly what his plan was. And a lot of the time, people underestimate change. They really do. And with that, they underestimate how much growth a company can sustain over a very long period of time. So just picking on Amazon there, it's important to define what a speculative business is to you. So, and just to drop this in, the good thing about good speculative businesses, i.e. an Amazon or an Apple in the early stages or a Tesla, is the risk-reward premium is so high that it doesn't need to make up a huge portion of your portfolio to have a profound effect, should it 10x, 20x or 100x even. These bets where there's the possibility of a 50 or 100x really don't need to be big bets in terms of how much you allocate to them. The return is so profound that you can make them a low risk area of your portfolio, and that's what people should do. And we'll get to that a little bit more in a moment. Okay, so what am I doing to prepare? And the quick answer is probably nothing, although that is a little bit showy and maybe untrue. And if anything, what I am really doing is just being ready to buy more of the stocks I love or others that become attractive. And if I go a little bit deeper into that, what that means for me is probably just being even more calculated in making investment decisions or buying stocks I already have or buying into new stocks. Definitely not sitting on the sidelines. I wouldn't advise that. So how you can prepare your portfolio. First thing I would say is, and this is the most important part, buy businesses to hold for the medium to long term. Now, I say medium to long term because I think a lot of people get mixed up in that they think a year or 2 years is a long-term holding period, and it's not. It's a fine holding period, I guess, 2 to 3 years, but that's a medium-term period. If you can do it for the long term, that's great, but it does make the buying process even harder because you really have to be convinced about the next 5 to 10 years for that company. So if we just scan over, and I'll give you some hints as to what I think makes a good business to hold for the long term. First of all, competitive advantages that are hard to replicate. Next is real and proven products that are in high demand. And third, growing businesses with high returns on capital. Now, growing businesses is fine, but I want to be a little bit more specific in terms of how efficient is that growth. So what this usually kicks out is businesses that grow with very low efficiency. So a lot of businesses that maybe use debt to grow, or businesses that are very capital intensive. And capital intensive businesses are not businesses that you want to own in hard times. I can tell you that for sure. Next is cash flowing assets, or at least visibility to cash flow. And I say at least visibility to cash flow because I do have a few investments that aren't necessarily profitable yet, but I will only invest if I can see a clear visibility to profit or cash flow. And lastly, low to no debt required. And this one's so simple just because, I mean, a lot of businesses will have debt, especially when the interest rates are so low as they are at the moment. But if a company has no debt or even very low debt in comparison to their earnings or cash that they have on the balance sheet, it's almost impossible that it will go bankrupt, or impossible that you will lose all of your money. So it's very important that you have that. And there are 5 points really that I think cover every aspect of the business that we should be looking for to know if we're buying a business that is a good business and suitable for a long-term hold. If it doesn't meet this criteria, it's probably not something you want to hold over the long term, or especially through a period of distress. Now, the next tactic or point I would make is try and think about where your portfolio of businesses, not just your portfolio, but the businesses within, will be in 5 to 10 years' time. Try not to think about your portfolio dipping 20%, or your portfolio, losing, even the businesses losing earnings in the next year or so, or even 2 years. Try and think about, if this business is a good business and meet all of the criteria above that we just went through, how likely is it going to be that they're going to be a bigger business than they are, with better earnings, with more revenues, with more customers in 5 to 10 years' time? And I can tell you, if they meet the criteria above, it's almost a certainty that they will have that, and that will reflect in the stock. So essentially this tactic is just try and look past whatever's happening in the next 6 months or 12 months. And these next two things I think go hand in hand, and they're no-brainers for me if you're looking for preparing your portfolio for a crash or correction. Avoid leverage altogether. Just avoid it. It can get you into trouble. The risk reward just isn't justified, in my opinion, especially when you think about where the market is today. We've looked at the indicators. We've looked at how likely it could be that a crash is on the cards, and it's just something to avoid altogether. And next, don't bet the farm. And I touched on this earlier in terms of not going all in. Although I'd never advise anyone to sit on the sidelines, I would suggest that you have a sufficient amount invested, but you invest, what you are prepared to lose, in the sense that if you do lose it, you still can eat, or you still have a roof over your head. You can still do all of the basic things, or live your life in a way that it doesn't change what you were doing before. That's what I mean by don't bet the farm. Don't go all in. And an indicator to see if you're ready, or to get an idea of if you are ready, ask yourself, would you be happy with a 50% drop in the market right now? And the reason why that's a good indicator is because if you meet all the criteria above, and it's very simple criteria, there's only 4 there with certain subsections in between, it means you should be happy with a 50% drop. Because if a 50% drop happens, you'll be able to buy things on sale, or buy more of the companies that you know are good businesses to hold for the medium to long term. So really ask yourself, would you be happy with maybe not a 50%, but let's say a 30% drop? Would you be happy with that? And I can tell you I'd be very happy if I saw a 30 to 50% drop in the market, or a 30 to 50% drop in my portfolio, because it means all of these companies that I have a very high conviction about and I want to hold for a long time are on sale relative to what I bought them for. And lastly, just tying in with all of that, some tips for capitalizing on a crash or correction. Firstly, don't wait on the sidelines. Timing any bottom or waiting for a correction, if it is going to happen, is near impossible and usually leads to worse results on average. Or actually, not usually, it's proven it leads to worse results on average if we go back in time. Second, value a stock and buy at a price that you're happy with. Don't worry about anything else. Don't worry about what other people are getting for it. Don't worry about if it's going to move down another 5% tomorrow, because if you don't go all in on it, then you should have some money left to buy that. If you really can't handle being that critical about buying a stock, then just dollar cost average into the position if it starts to trend down. History is proven that lump sum investing does actually lead to slightly better results than dollar cost averaging, but the marginal difference isn't much at all. So it's much harder to lump sum invest than to dollar cost average. So if you're comfortable with doing that, then do it. Just don't wait on the sidelines. Second, create a watch list of stocks. And this is important that you do it. Think about what businesses you would like to own, regardless of the price. And then once you've done that, get that list of good businesses with target prices. So actually go and value them. Or if you don't want to go through the process of bottoms up valuing them, just get a good idea of what price you would be happy with, to buy. And don't stray from that just because you've seen it's got, 10% off that, but hasn't quite reached that yet. You've got to be firm with it, because otherwise you'll get yourself into trouble with just buying for no reason. And I guarantee if you did that, it will drop the next 10% in a week or so. That's just how the devil of the markets work against you. Second, set alerts. Set alerts on these watch lists of stocks and the prices in which you want to pay for them. Don't watch the markets move up and down every day. Try to just switch off your investing app if you can, or your brokerage account. Set alerts and just tell them to let you know when a target price is hit. I always feel that's the best way to do it. And the third one, which is the hardest to do actually, especially when a market is crashing, don't sell. And in simple terms, if you don't sell, you don't realize any losses. Just like if you don't sell your positions when they're up, you don't realize any profits. It's all paper losses and paper gains as of that point. So one thing that history has shown us is that whenever the market does crash, it starts to trend back up. And if you go by the 2020 crash, it trends back up fairly quickly. In any case, try and think about the business, don't think about the stock. And so that's about it, guys. I wanted to keep it very simple, and hopefully I did. There wasn't much to it. I had a couple of requests to do this video, so hopefully all of you enjoyed my thoughts on a stock market crash, how likely it is, and what I would be doing to prepare, and what I would advise you doing to prepare or capitalize. Let me know in the comments below what your thoughts are on a possible stock market crash or correction, and maybe what your strategy is for investing. I'd be keen to know. Leave a like if you enjoyed the video, helps the channel out greatly, and subscribe to the channel if you haven't already, or if you're new around here. We'll have some more videos coming out later this week. Thank you for watching. Good luck with all your investments.